The Federal Reserve, often referred to as the Fed, is one of the most powerful financial institutions in the world. Yet, despite its immense influence over the U.S. economy and global financial markets, there remains an ongoing debate about who really owns and controls it. Is it a government entity? Is it a private bank? Or is it something in between? To unravel this mystery, we must delve into the history, structure, and functions of the Federal Reserve, exploring the key players who influence its decisions. The creation of the Federal Reserve. Before the establishment of the Federal Reserve in 1913, the United States had experienced frequent financial crises, including bank failures and economic recessions. The Panic of 1907, a severe banking crisis, exposed the weaknesses of the existing monetary system, prompting calls for reform. In response, Congress passed the Federal Reserve Act, signed into law by President Woodrow Wilson on December 23, 1913. The primary objective was to create a centralized banking system that could stabilize the economy by controlling the money supply, managing interest rates, and serving as a lender of last resort. However, the creation of the Fed was not without controversy. Many critics believed that it handed too much power to private banking interests, allowing a small group of financial elites to control the nation's money supply. To understand these concerns, we must examine how the Federal Reserve is structured. The structure of the Federal Reserve. The Federal Reserve is neither fully government owned nor entirely private. Instead, it is a unique hybrid system composed of 1. The Board of Governors. This seven-member board, based in Washington, D.C., oversees the entire Federal Reserve System. Members are appointed by the U.S. President and confirmed by the Senate, serving 14-year terms. The chairman and vice chairman are also selected from among them. 2. The 12 regional Federal Reserve Banks. These banks are located in major cities across the United States, including New York, Chicago, and San Francisco. They operate independently but under the supervision of the Board of Governors. Each regional bank has a president who is selected by its board of directors. 3. The Federal Open Market Committee, FOMC. This powerful committee sets U.S. monetary policy, including interest rates and money supply decisions. It consists of the 7 Board of Governors members and 5 regional Fed bank presidents, with the New York Fed president holding a permanent seat. 4. Member banks. All national banks in the U.S. are required to be members of the Federal Reserve System. These banks own shares in their respective regional Federal Reserve banks, granting them a role in electing some of the directors of these banks. This structure raises a critical question. If private banks own shares in the Federal Reserve banks, does that mean they own and control the Fed itself? The ownership debate. One of the most misunderstood aspects of the Federal Reserve is the concept of ownership. While private banks do hold stock in the 12 regional Federal Reserve banks, this stock does not function like typical corporate stock. These shares cannot be sold, traded, or used to gain control over policy decisions. Instead, they exist primarily to ensure that the regional banks are financially stable. Furthermore, the Federal Reserve's profits do not go to private shareholders. The Fed earns money primarily through interest on government securities and other financial activities. After covering operating costs, the vast majority of its profits are turned over to the U.S. Treasury. Despite these facts, critics argue that the influence of private banking interests on the Fed remains significant. Many of the Fed's key decision makers, including regional bank presidents and Board of Governors members, often have strong ties to Wall Street. The New York Federal Reserve, in particular, wields immense power due to its role in conducting open market operations, and its close connections to major financial institutions raise concerns about conflicts of interest. The role of the Federal Reserve in the economy. The Federal Reserve's main responsibilities include controlling inflation. The Fed manages inflation by adjusting interest rates. Raising rates slows economic growth, while lowering rates stimulates borrowing and investment. Regulating banks. It ensures that banks operate safely and comply with regulations to protect depositors. Managing the money supply. The Fed can increase or decrease the money supply through open market operations, buying or selling government securities. Acting as lender of last resort, during financial crises, the Fed provides emergency loans to banks to prevent systemic collapses. Throughout history, the Federal Reserve has played a central role in managing economic crises. During the Great Depression, its failure to provide adequate liquidity worsened the economic downturn. In contrast, during the 2008 financial crisis, the Fed took unprecedented actions, injecting trillions of dollars into the banking system through bailouts and quantitative easing. The Fed's influence on global markets. Beyond the U.S., the Federal Reserve's policies have global repercussions. The U.S. dollar is the world's primary reserve currency, meaning changes in Fed policy impact international trade, investment, and exchange rates. When the Fed raises interest rates, it can trigger capital outflows from emerging markets, destabilizing their economies. Conversely, low interest rates can inflate asset bubbles worldwide. Because of this influence, many foreign governments and financial institutions closely monitor the Fed's actions. Some critics argue that the Fed serves the interests of multinational banks rather than the American public, particularly when it implements policies that benefit Wall Street at the expense of Main Street. The ongoing controversy. The secrecy surrounding certain aspects of the Federal Reserve fuels speculation and conspiracy theories. Unlike other government agencies, the Fed is not directly accountable to voters, and its monetary policy decisions are made behind closed doors. Although it publishes meeting minutes and reports, many believe that the full extent of its decision-making processes remains hidden from public scrutiny. Moreover, some question whether the Federal Reserve truly serves the interests of the American people or if it operates primarily to maintain the dominance of elite financial institutions. The 2008 financial crisis exposed how the Fed bailed out major banks while millions of Americans lost their homes and jobs, reinforcing concerns about its priorities. Conclusion. The Federal Reserve remains one of the most enigmatic institutions in the world. While it is not a private bank in the traditional sense, its structure allows private banking interests to play a significant role. Its immense power over the economy, combined with limited public accountability, makes it a subject of continuous debate. Ultimately, whether the Fed is seen as a guardian of economic stability or a tool of financial elites depends on one's perspective. What is clear, however, is that understanding its true nature is essential for anyone who wants to grasp how money, power, and policy intersect in the modern world.